Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing a quick response video to a question I was asked on the channel. They had asked if I could quickly and briefly go over the stocks that were invested in within my wife's Roth IRA account over the last 6 months, give my opinions or a little bit of information on each one. If I could repeat the purchase, would I buy them again? What's been your best and worst choice? So that's what we're going to be doing in this video. I'm going to try and make it as quick as I can. There's a whole lot of stocks here, a lot of information I would like to cover, but I've recorded this video 10 plus times, and each time it's either too long or I should probably not include something in it. So we're going to quickly go over these stocks here. So right off the bat, my best choice is Apple. Apple right now, been paying out dividends for the last 5 years, but also increasing them over the last 5 years. Very low payout ratio, I believe, as their service sector segment gets larger and larger and becomes more profitable. It'll be able to just churn out profit and become more passive. It'll turn eventually into one of those dividend aristocrats that has been paying out dividends for 30 plus years. It'll be one of those Johnson & Johnson's, Procter & Gamble's. They'll just be one of those profit machines, and they'll be very passive. Now, the worst stock is definitely going to be Altria Group, not only for their loss, because I do have other stocks that are down as well, such as Caterpillar, Walmart, AT&T, but because looking at it now and their products, if Altria, they do Philip Morris. So they basically sell cigarettes. They do beer as well, brewing companies. I am not a smoker. My wife's not a smoker. I wouldn't want my child to smoke in the future. So I think, once the stock either recovers, I don't know if it will. I think that smoking is kind of going out. There's always going to be that segment of the population that smokes, but I believe that cigarettes is kind of going away with, and that whole new thing is kind of come up and coming, that things that look like a little USB. I don't know what they're called, but I think overall that stock will just be moved out of the portfolio, and I'll choose to replace it with something else here. And we're going to go over some picks up here in the future, but that would be the worst stock there. So quickly going over each stock and whether I would buy them again. So Apple, starting off at the top. Apple is a great company. What do they do? They sell phones, computers, digital music. They have software. They have their services segment that's growing, quarter after quarter, year after year, and getting larger. Right now, they have 5 years of dividend growth since back in 2013, but I believe this one will quickly turn into a 10 plus dividend growth, a 20 plus dividend growth, a 30 plus dividend growth with time. Very low payout ratio. Would I buy them again? Yes, I would buy them again, and they've been profitable within the portfolio. Next, we have AT&T. AT&T here, it's currently down nearly 15% due to the extra debt that they took on when they acquired Time Warner. But what do? They offer services and products worldwide. They're an amazing company as far as dividend growth. If you're a DGI, a dividend growth investor, you're looking for those companies that have a payout ratio that is safe. 60% or under, I would consider safe. This one's at a 56.7. Very solid history of having dividend growth past 33 years. 1985, that's an amazing year. If we take a look at their history here, it's just nothing but up, 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 up. They did a couple special dividend payouts here, a couple stock splits back here, where they basically doubled your dividend income. It doesn't matter if their equity goes down in time. Eventually, they will recover from their losses. Plus, you're getting paid out those dividends. That's getting reinvested, buying up more shares, increasing your dividend payout. And solid company there. I would purchase them again. Johnson & Johnson, 55 years of dividend growth since back in 1963. Very solid payout ratio. They're down for the year 5%. This is mainly due, I believe, to Amazon acquiring pharmaceutical and medication prescription companies. That'll kind of conflict with this, but Johnson & Johnson is just one of those large consumers. They are consumer producing companies that produce products in the healthcare field, the medical devices. Amazon will come in there, but I believe Johnson & Johnson's products, they will have that better, I wouldn't say consumer, what's the word? I don't know. We'll see how this one kind of plays out. Dividend growth, 55 years. That's very solid right now. Their net income has changed recently due to tax reform. I'd like to see how this one kind of plays out kind of going forward. Would I buy them again? Yes. Currently, they're a great stock to buy and hold. Next, we have Kimberly Clark. 45 years of dividend growth. Great for DGI investors, dividend growth investors. Been paying out an increase in dividends since 1973. Very healthy payout ratio of 59.8. And solid company, Kimberly Clark. If you've heard of the Kleenex. Kleenex is one of their main products that everyone and anyone has heard. If you've blown your nose, you're going to blow it into either Kleenex, or if you don't choose Kleenex, you're just going to get snot in your hands. They also produce Huggies and a bunch of other consumer products that you'll find basically at any store out there. They'll probably carry some sort of Kimberly Clark products. They've been kind of hurt recently due to kind of going into the year. Their net income has been dropping slightly, but that's kind of what caused them to kind of drop. But great buying opportunity. Currently down in the portfolio just means that we're buying more at a discount and we're getting a better yield on cost. We're increasing or decreasing our unit cost average. So that is Kimberly Clark. I would definitely buy them once again. Lockheed Martin, in times of uncertainty, when we're talking against North Korea and Russia and all sorts of other stuff, Lockheed Martin is one of those places you'd probably want to be invested into, just because they're they have aerospace defense products and services. They work with the government developing new technology. I think it's overall great company. There's another one out there, what's it called? Rayzine, something of the sorts. They produce weapons and stuff, but defensive products, those will always be in some sort of need. They've had dividend growth for the past 15 years, since back in 2003. I believe it's actually been longer. If we look at 2003 here, yeah, they had no short. I'm not sure why this thing says 13 years or 15 years. It's actually been much longer than that. So very healthy payout ratio, solid company, definitely worth a pick or a look at for anyone's portfolio. Pfizer drug manufacturer. They produce products for both humans and animals. They're basically a biopharmaceutical company, and they create medical devices and vaccines. So strong company, one very similar to AbbVie or Abbott, very solid companies as well. I was invested in Pfizer and AbbVie on my own portfolio. A lot of the stocks within my wife's Roth IRA are carryovers from my own portfolio on Merrill Edge. Apple, AT&T, Johnson & Johnson, Kimberly Clark, Pfizer, WP Carey, Walmart, Caterpillar, Cisco. These were all stocks that I was invested in myself in my own portfolio. Would I invest in this one, Pfizer, right now? Yes, absolutely. Great stock. There's only a few pharmaceutical companies out there that I would even look at. Pfizer, Abbott, and AbbVie. There's also, what's the other one? There's one other one out there, very strong as well. Can't think of the name right off the bat. Next, we have Prax Air. Prax Air sit in the portfolio, currently positive. They produce gas products. Here it says synthetics. They're actually be doing a merger pretty, recent, coming up here soon with Lendell Group. It's also another gas producer, very huge. If not one of the largest, they're going to be one of the largest gas producing companies soon. They have a very solid history of paying out dividends, 13 years, so they're a dividend champion, very solid dividend payout. If we go back and look at 2005, what did they do? It had a stock split, 2-for-1. They doubled your dividend income, and it doesn't actually look like they stalled, which is completely fine. So this one actually, this says 13 years, actually has much longer history of paying out dividends. So this has been weird with Lockheed Martin and Prax Air. So very weird there, but solid companies. You're always going to need natural gas, gases, synthetics. Very solid, strong company. Blackstone Group, we have an asset management. They do real estate as well. I like that about them. They only have 5 years of dividend growth, a little bit high payout ratio because they are, this one's actually, their cash flow is a little bit funky because they own so much assets and they're in debt in those assets, because they own real estate. It's leveraged. It's one of those leveraged companies out there, so it's very funky as far as how their financials look on paper. Dividend growth for the last 5 years. Very weird one here. This one, it changes my dividend each month. They are a quarterly paying dividend, but you can see here it's very sporadic, and that just kind of goes with the way that their assets are. If they have great assets and they're paying out very nicely, they pay out very huge chunks of $2.32 right now. Very high dividend yield, but this kind of trades back and forth. So very weird looking, very weird company there, but overall has been great in the portfolio. It has gone down slightly earlier in the year, but it's up now by nearly 10%. So solid company. I would definitely buy this one as well. WP Carey, this one is one I had over on my Merrill Edge portfolio. I had EPRO and WP Carey. These are all real estate investment trusts. WP Carey is one of them that they own across the world. They're not only national, but they own offices, they own warehouses, hotels, lots of commercial property, solid dividend growth for the last 17 years since 2001. Payout ratio is a little bit high because it's a REIT. They have to pay out a high percentage to their shareholders in order to meet tax rules. It's non-qualified, but it's purchased within a Roth IRA, which means it's completely tax sheltered. Don't have to worry about paying taxes on these dividends being paid out at my regular income tax bracket. It goes straight into the account. I just got paid out, nearly $10 from this company. If we go to our activity here and click on the dividends, we can see that WP Carey just recently paid out $6.07. How much do I own, or how much is owned of them? Let's see here. WP Carey, $384 invested in this company, just paid out $6 the quarter. So very strong company, very strong financials. Instead of lowering their dividend, they just lock it out and they have these special payouts. So during times of pullback, they lock their dividend, but if you're a long-term investor, they reward you by paying out these special payouts. So it almost be like they are increasing their dividend, but instead they're rewarding those that have stuck through and have continued to be long-term investors in their company. So solid real estate investment company and commercial worldwide company here, WP Carey. Would I buy it again? Absolutely. Walmart's, retail, superstore, they're consistent dividend payer for 43 years. They're known as the inexpensive department versus against, Kroger's or Target. They are overall, they're getting into Whole Food style, so they have a lot of organic. I've noticed that as I go to Walmart, I go to Food for Less, Fred Meyer's. It just really depends on where I'm at. I work very close to a Walmart. I can look out my window and see it. So right after work or during my lunch break, I can walk right over, walk through the store, pick up a couple groceries, throw them in the fridge at work, and take them home. Easy, easy peasy. Mainly known for their dividend growth. So 43 years since back in 1975. Very solid payout ratio at 43.1. They're currently down for the year. They are, Amazon's that huge elephant in the room. I believe Walmart will turn around with time. They're working with Microsoft on creating artificial intelligence, their website design. They've been revamping it. I think we're going to see some positive movement in Walmart. Recently, their net income has gone down. The revenue has been on a decline slightly. But long-term vision in this portfolio, this company will continue to increase and pay out dividends. And with time, Walmart will recover and kind of, they're profitable versus Amazon being not so profitable. So we'll see how Amazon blows up in the future if it does implode on itself. So next, would I buy Walmart again? Absolutely. Altria Group. So this is this is my ugly duckling of the portfolio. So this one here, Altria, ticker symbol MO. They do cigarettes with Philip Morris. They also own some companies that do beer and brewing. I'm not against beer. I don't drink heavily myself or very much at all. I may have one on occasion on social. I don't smoke. My wife doesn't smoke. I wouldn't want my child to smoke. So not only is it, down for the year, it's kind of going out of the norm. Millennials, they don't smoke as much as the older generation. They're more into vaping, that USB looking thing. I don't do any of that myself, but I think with time, this one will begin to get faded out. And, unless they can kind of change and keep up. This was one, I'm not sure how this got added to the portfolio. Maybe I mistyped the ticker symbol, but it's there, it's down. I'm not going to sell it off right now. I'm going to look at what I can replace them with. We'll do some sort of a video on why I'm replacing it and what I'm replacing it with. Dividend growth last 9 years since 2009. So it looks like, I believe this company cut their dividend in 2008 by 50%. Pretty high payout ratio. So if we go down here, look at 2008, they did cut their dividend by nearly 50% here, 86 cents all the way down to 29 cents. So huge cut there. Not a dividend growth investing style stock that you would want to hold forever, because it kind of deals, if you have those values that play against the company that you're investing in, you're not, you're more worried about your own values versus the company's financial metrics. That could be kind of wonky. I don't care. I just wouldn't do it myself, just because going forward, I don't think that the new generation would buy into it as much as some of the other products that are out there that are more addictive. Would I buy it again? Probably not. No, I would choose something else to invest money in. Here we have Avery Dennison, ticker symbol AVY. They are known for their paper products. I think they are sticky notes. They do postage stamps, tapes, basically anything with an adhesive. They've been having dividend growth and paying out dividends for the last 7 years, since back in 2011. So I'm not sure if this one recently started paying out dividends. I believe it's one of my 6%ers. So here in my portfolio, it's 6% because the history of it isn't very strong. I don't believe over the long term that, they may end up cutting their dividend. They have a very low payout ratio. So let's take a quick look at 2011. What do they do? So this one has a history of cutting their dividend by half. That's why it's 6% in my portfolio. So some of these other stocks here, I believe over the long term, they will have no problem, going through a downturn. They'll increase their dividend, they'll pay it out, they won't cut it. Whereas here towards the bottom, these haven't been paying out dividends for very long, and they're a little bit more riskier plays. Not really riskier, I suppose, but they're dividend paying stocks. So this one, paper products, adhesives, Avery, would I buy them again? Yeah, I would buy them again. Pretty solid company there. Caterpillar. So Caterpillar is mainly known for their construction and mining equipment. They're probably one of the largest producers in farm and construction machinery. So 8 years of dividend growth and paying out dividends since back in 2010. Very low payout ratio. If we take a look at 2010, we can see that this company did a stock split 2-for-1 in 2005, increased their dividend, and what happened here was, looks like they locked their dividend here for a while at 42 cents. They raised it in 2008, locked it in there until 2010, and then raised their dividend to 44 cents at the very end of 2010. But because there was 2 years there that they didn't increase their dividend, their history had started over. So solid company, doesn't raise their dividend during times of recession or pullback, but doesn't drop it by 50%. So it's there at 6% of my portfolio, and payout ratio very low, 32%. Very solid company. If one of the stronger of them out there as far as construction and machinery go, and just overall, if you're doing any sort of development with machinery, you're going to see a cat out there. Cisco System, 7 years of dividend growth since back in 2011. Very low payout ratio, or healthy payout ratio at 56.4. This one is sort of a, we use Cisco at my work versus Netgear, Juniper. We trust Cisco more than any other. Plus, we use so many of their services. We use Cisco Prime. We use Cisco StealthWatch. We use Cisco ICE. We use Cisco switches, routers, firewalls. It doesn't matter. We have a whole Cisco shop. That's where I work in infrastructure. So Cisco's kind of what I know, and they're getting more into security, which is this huge cyber threat now kind of going forward, where North Korea, Russia, they can attack us. So a lot of these companies are trying to amp up their security services, and I believe this is going to really benefit Cisco, because that's where their main focus is. Instead of trying to sell their products and hardware, they're going to try and sell their services, which will be more passive. And yeah, Cisco Systems there, dividend growth, 2011. Healthy payout ratio at 56.4. If we go take a look at 2011 here, they just began paying out dividends here in 2011, but have ramped it up really nicely. We don't have a whole lot of history of whether they would pull back during recessions, cut it and whatnot. So I just kind of kept it at a 6% in the portfolio. But I believe kind of going forward, it has strong financials, and I believe that they will just continue to be a very profitable company kind of going forward as they kind of revamp it. And we may see this one hold out during the downturn. So definitely something I would buy again. This was in my own portfolio over on Merrill Edge. And last but not least, we have ticker symbol SPG, the Simon Property Group. This is another REIT. The other one was asset management, had real estate, and I had another one with commercial properties. This right here is more retail. This is luxury outlet centers. This is malls. This is still out there and available. I may end up replacing it here soon. It is positive in the portfolio, but I think there are better investments out there, such as, maybe another REIT. I like EPR, which is more an entertainment properties REIT, and ticker symbol O, which is, it's also a REIT as well. But we'll see how this one kind of plays out. I believe this was it's a monthly or a quarterly. It's a quarterly pay and dividend stock. Okay. So dividend growth for the last 8 years. Payout ratio a little bit higher than 60%, but again, it's a REIT, so it has to meet certain tax rules of paying out their shareholders. If we take a look here at 2008, they did have a bit of a pullback, but again, similar to the other one, it does have special payouts here. But again, 6% of the portfolio, just because they don't have a strong history of paying out dividends and continue to pay out dividends during those downturns. You can see here during the downturns, they end up cutting it. Back in pre-2000, they cut their dividend, paid a special dividend out there. A couple cuts here as well going into that, coming out of that 2008 recession. They did cut their dividend here for a little bit, from 90 cents down to 60 cents for about a year, and then bumped it back up and have continued to rise over the last few years. So not terrible history there. You would still get paid out dividends. Your equity would be pretty healthy. You'd still be buying in, averaging down. So overall, strong company. Would I buy it again? Possibly, but I think there are better investments out there. So of the portfolio, I would buy every single one of these stocks again, except for possibly Altria Group and Simon Property. So that is it for this video. I just looked at the clock. It's at 22 minutes, which seems very long for quickly trying to go over these videos. Or trying to go over these stocks, but I did want to make it and kind of go over the specific stocks that I'm invested in inside my wife's Roth IRA. A lot of these, again, were carryovers from the portfolio on Merrill Edge, Apple, AT&T, Johnson & Johnson, Kimberly Clark, Pfizer, Walmart, WP Carey, Caterpillar, Cisco, and a few of these other ones were just kind of ideas that we got as far as creating a weekly style dividend portfolio. And instead of trying to time the market and be like everyone else out there who's not right now invested, I talk to my friends, talk to coworkers, hey, are you invested? No, I'm waiting for the crash. I'm waiting for the crash. They're putting it out, putting it out, putting it out. Soon 6 months goes by, a year goes by, 2 years goes by. They missed out on capital gains. They missed out on dividends. Instead of trying to time the market, trying to time each specific stock, we said, hey, your account's fairly new. Let's go ahead and put $5,500 in. That's going to give us an idea right off the bat what stocks are too high, what stocks are too low. And then for 2018, we'll average in on those stocks that go down, because with time, these strong companies, these blue chip companies, will recover and grow in equity. They'll recover, they'll pay out those dividends, we'll be able to reinvest those dividends, buy more shares, get paid out more dividends. So that is it for this video. If you guys have enjoyed the video, remember to give it a thumbs up below. If you are not yet a subscriber, hit the subscribe button. I would really appreciate it. If you have any questions at all, let me know in the comment section below. I always reply to your guys' comments. And if you are a subscriber, thank you guys for tuning in, watching the channel, and I will see you next time. As a quick disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor myself. I'm just trying to help others make their money work for them. Showing off my portfolio a little bit because, not everyone is going to have green all the time. There's going to be some red in there as well. And am I worried that I'm currently down 1.7%? Not really, because with time, dividends will continue to get paid out. This is a very strong portfolio, minus maybe a couple stocks here and there. But overall, very strong history of dividend growth, and that's what this portfolio was designed for. So thank you guys for tuning in. I will see you next time. Have a great day. Bye.